if you follow Mihir Vora on his X handle, you will see that he looks at some of these macros and the correlations very closely. It's an absolute pleasure to have him today at a very opportune time to try and tell us what does he make of all of that's happening around the world. Mihir, good morning. Thanks for joining in. And you mentioned in one of your latest posts about how, where you say that how we got here, and you attribute one of the reasons of this current global mood to the yen carry trade unwinding as well. What would you assess is the resultant impact here on? Because we've seen some bit of a fall in markets already.
Sure. Hi, good morning, Neeraj. So first of all, let's not correlate India directly with the yen trade. That was a general post. I guess it applies more to global markets where there are large hedge funds and large leverage positions using the Japanese yen carry trade as the leverage, so to say. So India, of course, is collateral damage. Hopefully, not too long, because first, I don't think we've got those kind of hot money flows from FIIs recently. As you know, the numbers have not been very good. So I don't think we have too much of hot money in India. And second is that cyclically also we are not that linked to the global economy because we are not export dependent like Japan, Korea, Taiwan, etc. So to that extent, the impact on India should be much lesser to start with. But having said that, the yen carry trade is a significant issue globally, and we have seen that post COVID, when the US rates were zero, almost close to zero, and so was the Japanese interest rate, you did see the yen being used as a large funding currency because of the fact that you got to borrow at zero in a depreciating currency. So that, I think, went on for almost 3-4 years, and it's become a sizable trade globally. And now that Japan started feeling the pinch of depreciating currency in terms of inflation, they had to react, which they did last week, and this is what we are seeing as a correction. So I think the yen has trended from 160 to 148 almost. So that's quite a sharp correction, and I do expect some kind of stability to happen. And if it doesn't happen, I do expect a significant central bank intervention from the Bank of Japan, because I don't think any central bank has a stomach for this kind of volatility in bond markets and equity markets.
Yeah, Mihir, good morning. That's a very good point. We've been talking about how Fed will come in and react since this morning, but Bank of Japan may have to, in Indian policy terms, rollback is a favorite sort of method. Not rollback, but they might have to soften the blow a bit. But, let's focus on what's happening in India. And I think your comment is very interesting, that the impact of the yen carry trade factor, or the fact that Japanese interest rates have inched up, so that's impacting the world, and how much it affects India is not as much as expected. We are seeing a sea of pain today. Do you think this sustains, or then domestic money which is waiting on the sideline comes in?
First of all, let's stop calling a 1.5% correction a big pain. It's par for the course for
nearly 2%. All right, and this pinch this morning.
Yeah. No, I think it's of course expected, given the fact that the world markets like Japan, Korea are down 5-6%. India could not go unscathed. But as we discussed, I don't think it's such a big issue. And so far, at least in the last 5 years, the Indian institution as well as retail investors have been conditioned to some kind of a buy on dip kind of a mindset, which has worked so far. So at least in the initial part of the correction, I do expect the buy on dips strategy to continue as far as the retail investors are concerned.
Okay, so buy on dip in the initial part of the correction. What is this initial part of the correction? You see this correction lasting a day, weeks, has just begun. Even you rightly pointed out that 2% is not even pain if you look at in what's happening in relative terms. But in the broader markets, the pain is truly deeper.
See, that will be a function of how the global markets ultimately pan out. My guess is a lot of the pain is already done. Japan is down like 15% in 3 days, and so are markets like Korea, Taiwan, which were quite linked to tech, I would say. And we also must remember that we are already in a Fed easing cycle probability. So people are expecting, the markets are expecting the Fed to start cutting in in September itself because of the US slowdown. So to that extent, the liquidity support by central banks to the markets will continue, I think. So I think whatever volatility we see should hopefully be very sharp and short, which we are in the middle of as of now.
Me just wondering, I know you mentioned that the BOJ might come and intervene. The Fed intervention or the rate change action, if it happens, will only happen, let's say, in September. So in the ensuing period, if the BOJ doesn't do anything, and if this yen carry trade unwinding keeps on impacting global markets, do you think we can go down further, or at some point of time, mutual funds like yours are sitting, I mean, I'm not saying you are, but collectively mutual fund houses are sitting on nearly 1 lakh crores of cash. Does that start coming in at circa 24,000, you reckon?
Yeah, there is certainly cash in the system, but I think it's more important to get the market call right, because I don't think any amount of cash helps when things turn sour, and vice versa. You don't really go against the fundamentals beyond a point. So cash can help to some extent for a few days, but it can't change the direction. So I would not bet on institutional money trying to save the market. That does not happen. Ultimately, it is fundamentals that need to save the market. And the Indian fundamentals compared to the rest of the world continue to look quite attractive.
Right.
So my guess is that ultimately local and global money will float the Indian economy and the Indian market.
Which is the point I was trying. I was not saying that you will a domestic institution or institutional money will come in and save the market, but do you reckon at valuations or levels of circa 24,000 or 23,500 or 23,000, whatever, is the sweet spot?
Certainly, I would say that will be the first support for the markets. A 5-7% correction would be a good entry point, at least in the first phase.
Okay, Mihir, you talked about a buy on dip strategy that Indian investors have sort of gotten used to. How should those watching this program right now and trying to understand what this global narrative means for Indian markets look at it? If there is going to be persistent pain in the US, what sectors does it hit the most? What are the sectors or spaces that you should look at which are resilient to these global headwinds?
Sure. So first of all, the first thing to do is not to do too many trades, because we also must understand that we are seeing the impact of the unwinding of the global central bank balance sheets after a long time. We had extra stimulus on fiscal and monetary side for almost 5 years. So unwinding of that also will not happen overnight. It happens over a period of time. So a lot of the sections of the market is used to easy money, which will be incrementally less easy, so to say. So I don't think we should be, trading too much, but rather taking a strategic call over the long term as to what our asset allocation strategy should be. And within that, I would stick to Indian domestics, which is basically sectors which are not that exposed to the global economy, because I think the global economic downturn will definitely be sharper than what we see in India. So India will still continue to grow at 6 to 8% hopefully, and to that extent, when the rest of the world is growing at say 2%, India does become an attractive market. So I would stick to domestic sectors like financials, like discretionary, like consumer, and of course the physical asset creation play like infra, construction, cap goods, etc. Over the longer term.
Liking financials right now, Mihir? I mean, it's a bit of a fear. I won't say pain point again, but it's a bit of, I think, trepidation this morning, wait and watch. But you talked about financials. Are any of those public sector plays, private plays looking interesting or will begin to look interesting?
Actually, the whole financial space is looking attractive. It's just that we've had borrowing costs staying so high for so long, that's kind of dragging down credit growth. But as we just discussed, we probably are near the end of the tightening cycle and beginning of the loosening cycle globally. So liquidity conditions should improve, and balance sheets have never been healthier for financials, both banks as well as non-banks. So tactically, I think we are more bullish on non-lenders as of now. But in the next few months, even lenders will start becoming quite attractive.
Okay, Mihir, appreciate you taking the time out and joining us and clarifying those points as well. Key points, thank you so much for that. Our viewers, Mihir Vora says that the yen carry trade, a global phenomenon, that impact being felt on our markets. And by the way, it is being felt because the Nifty is now at the lowest point of the day, 500 points gone, nearly 2% down for our markets. 24,200, a far cry from 25,000 all-time highs last week. Yes. Time for a short break then. We need a break really. On the other side,